Fundamentally, it's not that hard to time the crypto markets. We want to sell when everybody talks about crypto, right? When your taxi driver asks you about the next altcoin to buy, it's probably time to exit. On the contrary, it's time to buy when nobody talks about crypto, when there's apathy in the market, and potentially some people even call you crazy to buy. So there's some kind of correlation between the price and the attention on the asset. The problem is that attention isn't that easy to quantify, but let's have a look at a few numbers that might correlate with attention. For example, have a look at this. This is the trading volume of perpetual futures on Bitcoin. So those are bets on the price with leverage. When there are people in the market that are willing to put a lot of money with leverage on the Bitcoin price, things are probably somewhat heated, right? The market might not be very cool. There might be a lot of attention. Just have a look at how nicely this correlates. When there's a lot of trading volume on the futures markets, the price tends to be high. When there's very little trading volume on the futures market, we tend to bottom in the price. Now we have come up again, and of course there is more trading volume again. Instead of looking at the active trading volume in the perp market, we can also have a look at how many dollars are currently on average been bet on the price. So what's the open interest on the perps? And so this is to a degree a measurement of how much leverage there currently is in the market. Again, this tends to be high when the Bitcoin price is high. It tends to be lower when the Bitcoin price is low. And when we look at the similar price, say in April of 2021, compared to March of 2024, right? Bitcoin was at similar prices at the time. The open interest comparatively has grown quite a bit. So there was much more leverage in the market when Bitcoin hit the 72K in March compared to when it was close to the 70K in April of 2021. Now here's an interesting counter indicator. If a lot of people want to go long in Bitcoin, then the longs pay the shorts on the perpetual futures. It costs a lot of money to bet on rising prices. When the majority of people are bearish on Bitcoin, when most people want to bet on falling prices, the funding rate turns negative. So then the shorts have to pay the longs to bet on falling prices. So what this in turn means is that when a lot of people bet on falling prices, the market is very, very bearish, and we might already see a bottom, at least temporarily. It worked very well after the COVID crash. It also worked well before the bull run in Q4 of 2020. It also worked great over here after the correction from 65 to 35K, and then here after the FTX collapse. Whenever we are very negative on the funding rate, we tend to at least temporarily bottom out in the price. So it always makes sense to check this every now and then, especially after we have come down in the price. Is the funding rate historically low? If the answer is yes, it might make sense to risk a long position, to go against the grain, to be contrarian. Now, Bitcoin is traded by very different people. We've got the long-term holders that bought Bitcoin in the early days, that know a lot about the asset. Then there is Wall Street that just recently entered, that might accumulate over time. When we look at the ETF flows relative to the price, there is an interesting structure. So check out this chart. What we see in black is the Bitcoin price. What we see in green is how much the ETFs are accumulating or selling Bitcoin. It looks like Wall Street is still very pro-cyclical. In other words, they tend to buy up the tops. They tend to not necessarily buy at the bottoms. And they tend to sell very quickly once the rally doesn't continue as initially expected. So we probably should not follow what Wall Street is doing. It doesn't seem like they are the smart money here. But then we've got the long-term holder supply change. And that's over here in blue. They have much more impact on the price. Just have a look at the magnitude relative to the ETF changes, but they also tend to time the market better. In other words, they took profit when Bitcoin was around 70K. They bought back into BTC when it was around 50K. Then they sold again at 100K. And since we are at 80K again, they are heavily accumulating again. The smart money is getting into Bitcoin. And so we can either use this chart to figure out when to sell again, but there's also a more refined version, and that's the value days destroyed. So we look at all of the Bitcoin, we look at when did the Bitcoin last time move, and when the Bitcoin was very dormant for a long period of time, and there are a lot of Bitcoin in the wallet, Then once that Bitcoin becomes liquid again, once it moves, then we are destroying value days. So when the whales, when the diamond hands, when they suddenly turn into paper hands, that's when value days destroyed is going up. And so here is that chart. It shows us again nice selling opportunities. The indicator does not necessarily peak at the exact price peak of Bitcoin. So it was over here when Bitcoin was at 40K. It still went up another 50%, but still it was a good time to sell potentially. Then it peaked over here at 72K. Again, we went down and up again to 100K. It was still a nice, at least temporary selling opportunity. If you're riding the waves over the years and you're not just getting in and out of Bitcoin multiple times per month, but you do have potential tax implications of buying and selling, you're just riding the macro, then the value days destroyed turning red is a good potential approach to follow. Now let's go back to the beginning of this video. Why does it make sense to sell when attention is high? Why should we sell when more and more people onboard to the ecosystem, when even the taxi driver asks us about the next altcoin? The reason is that the price tends to grow faster during periods like this than the number of investors that onboard. And so the growth of the price has to turn around at some point. The long-term holders get all of those gains, and when they take profit, they're effectively dumping on all the new people that just entered. Most people that enter crypto start with losses, and only the people that stick around, that might continue buying, they then can become part of the minority that makes money over time. Check out this metric. This is the realized HODL ratio. This shows how many transactions are there currently across the short-term holders versus the long-term holders. When there are a lot of tourists that enter the space, when there's a lot of short-term holders in and not so many transactions among the long-term holders, that's when the market is heated. That's when the taxi driver asks us about the alts. That's when we exit. When we're then coming down with the price, so in this example it was on 20K to 3.5K, then all those short-term tourists get burned. They don't trade anymore. And the reason why we then bottom out at some point is because the long-term holders buy. So the long-term holders are supporting the price at some point. And so the indicator isn't perfect. It does not always flash red when we are at the top of the bull, but it gives us a general direction. We are not incredibly heated right now. There might be some more upside, but we are also, of course, not historically cheap. And so there are always two forces that fight against one another. There are the new entrants into the space that buy into Bitcoin, that push the price higher. But then there are the people that bought in early, the long-term holders, that see their net unrealized profit climb further and further. And the more there is net unrealized profit, the more potential selling pressure there is. And that's shown over here. When the average market participant is in a lot of net unrealized profit, some of that profit might get taken, right? If you start out with a portfolio allocation of Bitcoin of maybe 10%, and then Bitcoin does a 5x, you've got a lot of net unrealized profit. You might take some of that profit and maybe at least sell half of your position, potentially even more. And so this is then how all of that volatility gets created. Whenever many people are in the green, then the profit will get realized, potentially put into other asset classes, potentially also just used for plain consumption. Now there's also a more direct measure of attention. We can check out how many search queries are there for Bitcoin. When this is very high, again, the price might be elevated. When this is very low, we might have a buying opportunity. And so here is Google Trends. This is how often is Bitcoin getting searched for in the last 5 years. And have a look at this. The 16th of November 2024, that was over here after Bitcoin has already risen and got closer and closer to 100K. Compare this to the 13th of October when search interest was comparatively low. That was over here when Bitcoin was only at 62K. And so since we are not very high on search volume for Bitcoin, we might still be somewhat okay. Of course, the net unrealized profit is not very low and some people might sell, but the long-term holder selling seems to still be quite low. In fact, they rather have bought recently. And so there are different time scales to play this game. We can just look at this short term. We can try to ride the waves. We can try to buy and then sell a few weeks afterwards. Or we just ride the long term. Because long term, I do believe there are good cases to be made that Bitcoin is likely going to outperform most other major asset classes. Just have a look at how quickly money is flowing into the system. This is the stablecoin market cap. So this is DAI, Tether, USDC, BUSD. and that grew since beginning of the year by 17%. So if we annualize this to the entire year, we're probably getting close to 40% of additional money getting into the space. And this expansion of the stablecoin market cap started already in October of 2023. So since then, Bitcoin has appreciated by 282%. And so of course, this does not always expand, right? There was also quite a bit of a deceleration with the Terra Luna collapse and the FTX collapse. But right now we are still in growth mode. We are also long-term in growth mode with the Bitcoin ETF. Of course, they are not always buying. There had been some unfortunate selling in February and March of this year. But the assets under management measured in Bitcoin tends to climb up rather consistently. At the beginning of the year, we were at 1.13 million Bitcoin assets under management. Now we are at 1.19 million. Well, here's another reason to be long-term bullish on Bitcoin. Over time, Bitcoin gets lost. And as long as you're not one of those people that loses Bitcoin, as long as you keep your funds safe, you are benefiting from the lost Bitcoin. So we see over here is the Bitcoin that hasn't moved for the last 5 years. Now, not all of that Bitcoin might be lost. Some of it might reactivate again at some point, but the net tends to go up over time. And there's obviously also some Bitcoin that have been lost in the last 5 years that will then become part of this graph. Now, how quickly is this going up? In the last 5 years, it went up by roughly 10% as a fraction of the overall supply. So we're losing roughly 2% of Bitcoin every year. And that is more than how much currently Bitcoin expands every year. Only 0.8% of Bitcoin supply gets added every year. So the Bitcoin mining is less of a potential selling pressure compared to how much the price goes up because of the lost BTC. So Bitcoin only inflates by 0.8%. Fiat money, on the other hand, so this is USM2, that is going up by 5.8% every year. So this is the logarithmic scale. Here's the same on the linear scale. So just because of that effect, Bitcoin has to go up over time, right? There's less and less Bitcoin. There's more and more fiat. And if Bitcoin stays around, if it does not become irrelevant, and if at the same time, the liquid Bitcoin even shrinks more and more because Bitcoin gets lost and less Bitcoin is getting mined, then of course the price has to go up over the cycles. There is a lot of volatility. We've seen this. But if you don't care about this whatsoever, if you've got a very, very long-term time horizon, you don't want to bother timing the market, then just buying Bitcoin a little bit every month is extremely profitable. This is how I made my first money in crypto. When I didn't know as much about crypto, I didn't try to beat the market too much. I simply just bought into Bitcoin a bit every month. And I think that's the right approach for most people that don't want to spend too much time on researching crypto and crypto cycles. Just have a look at how effective that is. Let's say you started dollar cost averaging over here. So just before the bear market started, we went sideways for a bit, then we crashed down by 73%, and then we recovered again, right? Because long-term Bitcoin tends to go up due to adoption, due to the lost BTC, due to the very little inflation. So let's say you start buying and you start at the same time where most people start, when there's a lot of attention on crypto and when the long-term holders first dump on you. But if you're not getting too worried about this, if you actually have the long-term in mind, then what kind of performance can we expect? Now, Bitcoin itself during that time went up by 78%. But let's say instead of buying everything over here and getting wrecked and doing nothing afterwards, you instead just bought $1,000 every month until today. If you did that, you would have invested $49,000. You would have acquired 1.3 Bitcoin, and that then turned into $139,000. So that's an ROI of 184% over that time period. So Bitcoin itself went up much less, but because you buy in every month, no matter what the price is doing, you're also getting a lot of cheap Bitcoin in the meantime. And that's then what's driving all of that massive outperformance. And so some people regard Bitcoin's massive volatility and those crashes as a problem and as a justification to maybe only have 1 or 2% of net worth in Bitcoin. But other people might see this as a feature, as in if you believe in the Bitcoin story very long term, then those low prices are buying opportunities. And we now just played with the assumption to buy the exact same amount all the time. Let's say you become just a little bit fancy and you buy a bit more at those bottoms. Let's say you spend a bit less on consumption and you're buying in more at the bottom. You're going to make much more return than just this 3x over that time. Let's say you take a simple indicator like the realized price. So whenever the current price is below the realized price, or when the market in aggregate is in net unrealized losses, you're buying in a bit more Bitcoin than you're really enjoying the subsequent bull run. That's what I personally did. I took a personal loan at the time and paid that off over the next 2 years to take advantage of this rally, right? This is then a 5x rally. If you put in $2,000 over here every month, you are making $10,000 back in a very short period of time. And again, this of course assumes that you believe in Bitcoin long term. And this is what this is all about. You can't do this with every asset. You can only do this with a few assets. You can do this with property and with a broadly diversified stock portfolio. You can do this with Bitcoin, but you can't do this with a single stock. You can't do this with a single altcoin, because we need to know where this is going long term. If we put in a lot of money all the time, even when we are depressed in the price, then we need to have strong enough of a conviction that there will be a recovery at some point. And that conviction only comes with education, with learning more and more about the asset class, and potentially also learning more and more about our money system, as in how much money actually devalues over time, which I believe is 5.8% per annum. This is how much the monetary base is expanding over time. Now, after so many years in crypto, I think there's only two strategies to make money in this market. It's either trying to find altcoins very early, potentially using wallet tracking, buying things before the masses do. And while this is a strategy that can work, it's also comparatively risky. Things like Virtual Protocol or SPX 6900 went up massively this year. But if instead you bought Optimism or IMX or Polygon, you wouldn't have had such a nice time. Now, with small bets, a few $100s here and there, the strategy does make sense. But for the vast majority of the portfolio, we have to take less risk. Now, the common narrative is that this less risky bet is simply Bitcoin. And while it's true that there's less risk in Bitcoin than in many altcoins, the price can still go down by 77%. So what can we do? I think the answer lies in taking advantage of crypto's market structure. Most altcoins underperform Bitcoin most of the time. So for example, have a look at this again, right? This is the performance of the top 100 cryptocurrencies in the last year. Again, SPX 6900 outperformed everything else. And here at the bottom, we see Bitcoin. So in the last year, Bitcoin appreciated by almost 72%. Now, how many altcoins outperformed Bitcoin? It's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. Out of 100 altcoins, 17 outperformed Bitcoin and all of the others underperformed. And so with a larger part of the portfolio, we can take advantage of this market structure. So instead of buying Bitcoin, we can buy this here. Now, this is the exact same time frame that we see in those charts. And what we see here is again a Bitcoin chart, but it's slightly different. It's not Bitcoin relative to the US dollar, it's Bitcoin relative to Balancer. So what we are seeing here is Bitcoin's relative performance to one of the altcoins, an altcoin that tended to underperform over the long term. Now, why do we see that constant outperformance of Bitcoin over the alts? So it's not just that most altcoins underperform, it's also that the underperformance tends to be rather constant. The reason for this is tokenomics. It's an expanding token supply. Because that's how the venture capitalists and the members of the teams of all those projects make their money. They've got a vesting schedule. They get a token allocation, but they can't sell directly. They have to sell over time, and that depresses the price relative to Bitcoin. Yes, on bullish days, everything is going up. But when we zoom out a little bit, most altcoins are not doing as well as Bitcoin. Now, this is not common knowledge, but we can actually set up a position in a portfolio in a way that we make money when the relative performance of an asset versus another one is going up. So we don't have to bet on the crypto macro. We don't have to bet on Bitcoin going up or down. We can just make money when something outperforms or underperforms. Now, I've made several tutorials on that topic, how to profit from falling prices or gaining from relative valuations, or over here, how to win in bear markets by shorting altcoins. Now, it's not important what the macro is doing if we focus on the relative valuation. Again, the nice thing about the strategy is that it works in any market condition. At the bottom is again Bitcoin. Bitcoin has its massive crashes, and the largest retracement that we saw in this chart was maybe 50%, while the gain was much, much larger. So this is an 8,000% gain in relative valuation, while Bitcoin itself only made 100%. And so I'm of course sharing my own trades as well. Check this out. This is where I opened a short position, a relative short position on the Trump token. That was on April 30th. What we see here is Trump relative to Solana. Some community members entered the short as well. And then I closed the position a few days later for a gain of 142%. Now I actually shorted Trump twice, so this was an earlier trade. And again, here are a few other trades that our community members are making. So if we set this up right, if we've got risk management and hedging properly in place, there is real risk-adjusted alpha in positions like this. And so of course I shorted the Trump token again because of the tokenomics. Over time, the Trump supply increases. And it's really important to understand this concept. I believe that risk adjusted, if you want to make large bets, not just a small bet on the altcoins that might do 100x, if you want to bet a lot of money of our portfolio, then we have to bet on something that risk adjusted performs relatively consistently. So this is Trump in US dollars. And if you just bet on Trump going down, then when the market itself is appreciating, you've got a problem, right? Over this time frame, Trump did not go down. However, Solana relative to Trump went up. So that's the exact same time frame. That's a gain of 35%. So it's all about looking at what tends to do worse relative to something else over time. And how to set up those positions is explained in the videos over here. And so feel free to check it out. It's currently 125 US dollars per month. It used to be 165 at the peak of the bull run. Now attention is still relatively low, and so you can lock in the lower rate. I will not increase the rate for anybody that's already subscribed. Only the people that sign up when everything is hyped, they will get the higher price. But if you sign up now, you lock in that price. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. Feel free to also check out Premium. Again, the link should be somewhere over here. You can just click on a link here. It should bring you to the website. And so yeah, see you next time on YouTube or see you in Premium. Cheers.